Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Moving right along. Risk profile on our trade. Our maximum risk or loss, the difference in the strikes minus the net credit. This is going to occur in the underlying strike of those long options. We do the numbers, you'll see this work out. The maximum reward is potential through the long option expiration. So whatever that is, if we get that movement breaks through, that cost, the break even, the upside break even, the long cost plus the number of contracts sold times the difference between the strikes minus the net credit. Once again, when we do the number, downside is the lower strike price plus the net credit. By the numbers. Current spot level for U.S. dollar euro 9.46. Now they moved the decimal point over. We don't have we drop off behind it. So we're going to buy in the symbol for the U.S. dollar euro FX option EUI. We're going to buy the January 2012 72 calls at 60 each. Okay. So our total cost to put the trade on, put the long side on, is $120. We're going to sell lower at 69.50, which is going to be basically the at the money 946 but for 153. So we take in 153, we put out 120, and we can make a net credit on the trade of $33. Excuse me. The maximum loss in this trade occurs right on the long option. The underlying, remember, it's at 69.50. This is where that statement I made earlier that you lose on the trade, even if the underlying goes up. Barbara's asking, so you must put the trade on credit. I would say even or credit is going to be your better risk profile. Debit is definitely going to change whole profile. So you're looking to do this for at least even, hopefully for credit. And these numbers are going to start to show you why this works out. But if the underlying goes to 72, which is the strike price of our long option, the long calls expire worthless. Just remember, intrinsic value, it's either worth something or it's not. 72 it's zip. So it's $120 loss. However, the other side of this, sold actually gains in value as well. So 69.50, 70, or to 72, excuse me. It's now worth $250 in intrinsic value on the sold. So we lost 97 on that trade as well. So combined with the long call, total net loss $217, 120 plus 97. So this is the oddity in this call ratio backstroke. You get a movement upward until you break the plane, if you will, of the long calls. You're still in so the upper strike is the key level. That's why this analysis is trying to get an optimal strike key here. And once again, that's why you like to do this for credit, because at least it keeps keep things in a even plane, if you will, even or credit. After the underlying surpasses the long strike, your losses begin to decrease and profits begin to occur. So now you have the one long option. After the FX strike price starts to offset sold option. So the one long call cancels out the movement in the sold option once you get above the strike. Now you have one long option left standing, and then it begins to show the profit. Actually, now it looks like a whole lot like just a plain old long option. But you need to remember, we credit, we get. And there is one of the differences in looking at a ratio backspread when you're extremely bullish on the underlying. A long option. You do have a little bit of an alternative in it. So the numbers in making money are correct. An aspect of call ratio backspread, which we may think is odd, I certainly do. The possibility of making money. So the underlying moves nowhere. Long calls are worthless. Made 120 and we lost 120. But it goes nowhere. Our 69, 50, I believe, also expires for us. We received $153. It's paid for 33 credit. We at least get to keep the $33. Now, if we put this trade on over time, and that's where the however comes. There's always going to be one of these when you're dealing in options. There'll always be, well, sort of. Remember, it's an aspect of time regarding this particular spread that you need to consider. We recommend the trade established over a longer period. Within 30 days, perhaps long out, as we looking at long out as we set up from 6 months. That's a pretty long stretch out there. The question that comes up for you and I as traders is, if the underlying isn't moving, say, change our opinion on a particular strategy and look to make a gain. We set this up. We had a clear uptrend. We had a bullish on the underlying, and then all of a sudden it goes stagnant on it for whatever reason. How long? This is each individual trader, but we make our decision. We do have that credit tucked away up there. Nothing doesn't stop. And we do know where our loss would be if it doesn't make it up to the strike price. And if it doesn't changes and goes down, we've got the credit tucked away. Remember, we started to trip. We were expecting a bold move up. So when is our opinion of our opinion worth it for us to say we want to save some money and exit, unwind because of trade and move on to another one? I can't give you a specific answer. You know as well as I do. Each individual making continuing their analysis, you'll feel strongly and of course keep the trade on. You may say, frustrating, let me move out. So exit consideration for the expiration of the option. If this position is profitable and the underlying looking to continue to rise, you could buy to close the short option trade. To become just long a call option and go along and rise. We've now converted it to what we said it would turn out to look like anyway. Close out the short side. If the position has a profit, the underlying now is starting to look to stay at a specific level by expiration or region area. We're looking at particularly resistance for something here in an area, or it's becoming stagnant, not making any significant moves off current level or maybe a bit higher. Once again, buy to close the short call option, sell to open the call option at the strike price of an expected rise. Where do we think it's going to be? What specific level? Or is it going to be a little higher? Well, then what we've done is we've converted this into a bull call spread. We know that the profit now is the difference between the strikes less any debit in the trade, and the risk now is any debit paid to establish the trade. So we've rolled out a little bit, changed the structure of it, a little more maybe comfortable people's false. There's a couple ways to exit the trade, obviously. So the call ratio backspread. One last time, the credit spread, there's no upfront cost. We have substantial profit potential on that upside, the underlying, and we actually do maintain a possible limited profit potential on the downside. That's that credit feature that we have by Brinkman credit, and that's why I recommended that be what you try to do rather than try to any other way. Even okay, that works because we know because it goes down more on the trade. The disadvantage is you're going to be needing spreads, and this might be one level up. Some folks knows. I'm not familiar with how the folks out there gauge all that, because it is a little more spread than the average, I suppose. and actually less profit than on call. Same, right? And this is the issue. There are all alternatives out there. It's good to know that the trades out there, it may be a trade that you can be comfortable working with for a while, but if you need to know that there are alternatives on this out you could do. It may be not quite as complicated. Again, the hockey stick diagram, where the call ratio back spread. Let's move on to utilizing. Going away. Sorry, I apologize. We'll move through here, but I don't want to cause any mass confusion. Put ratio backspread. We just flipped this whole thing. Now we're going to be aggressive. We still need that volatility to go up and on direction for bearish and high volatility, and the underlying is heading down. That's a good thing. You need to trend downward, but need that upside consistent level. You need to take a look and say where it's changed and what we have to be careful of. Underlying options need to be liquid. Goes without saying. You want to execute for little or no cost. Net credit or zero cost. Our maximum risk limited for difference in strikes minus net credit times the number of contracts sold, and the maximum reward remains substantial. Now we're just flipping it. The reward is so substantial, but now the downside is substantial. Zero, which could be zero, but I still doubt that any exchange rate is zero. You guys shouldn't say that the way things are economic. Anyway, now longer usually safer. We want to allow the forecast. Okay. Now the time decay in this type of trade is a negative impact on long position. We haven't gotten away from that long, not short here. So we're going to buy 2 or 3 lower strike splits, which are going to be 1 or 2 lower than the full strike. Sell 1 or 2 higher strike, but again, these are around that money. All right. And it goes expiration date underlying and no strike credit. Mention the resistance. That stop or resist gets broken through. It's probably a good bait because you're looking at an upside movement there. It's time to unwind. Okay. And 1 month out, it's a good start to look at unwinding. The break even from the downside is the lower strike minus the maximum risk. Difference in strikes minus the net credit times the number of tracks sold. Right? The break even. The upside break even, the higher strikes minus the net credit. Reduced cost of entering trade. Limited risk. Substantial levered reward underlying lines sharply. In this case, you've got more risk if the underlying not. We don't have that little bailout that we had on the call side with ratio backspread. It is a complicated trade. You have to be careful of margins, trade management, and executing the trade as well. I will be honest, I'm not sure whether in the electronic world of spread executions that the exchanges have offered have been out of the exchange space for a little while. But I'm not altogether sure this type of spread, whether a ratio backspread call or is available in an electronic format. I check with the ISE, see that if in fact you can enter this as a trade or a broker. Probably a better place to do it with. Not to see if you can do this put it in as net trade or this credit or this or even the system will accept it that compute it at those parameters rather than you manually pick price and enter trade that way. Everybody's become very sophisticated in the spreads. I'm not sure how these more less common spreads. Okay. So this one on that, and let's read that. The ratio of call spread. Let's run through this. These are really the opposite of all ratio backspread. Now your net short options on the call side, and you become risk exposure is unlimited. Up becomes significant, and you have unlimited reward. That on itself, right there, warning flag. You're taking on an option that's a position that has a limited reward and risk. You need to be very careful with this. I think they are credit spreads, but they bring substantial risk exposure. For the call spread, you need a strong neutral to slightly bullish outlook. You want the volatility to be decreasing, and you want that underlying to be range bound. You need to see that it has a clear downtrend. Of course, on the upside, does it have a resistance area that we need to be aware of? Again, 1 to 2 ratio. It is in fact an income trade. All right. Remember, in most cases, in income trade, in the option, you identify your potential reward by the income that you take in. With the ratio call spread, this underlying must remain below the 3-point trade. The maximum risk, if that underlying pays off and goes way up, you have an unlimited risk in the trade. Okay, you don't have the bailout position doing some of the credit spreads. You've got basically a head tucked away in there. If it's going for a net debit and you're limited debit, if the underlying decreases, at your risk, you could lose the debit that you paid. All right. If the underlying goes way up, you're on that unlimited as I said. Net short options, so any time indicator is helpful. As we mentioned, volatility low and low. Now in this case, for the ratio spread, you want to put for as little time as possible because you've got a big unlimited potential risk hanging out. So you want to truncate. One way to take a lot of the edge off is to truncate time exposed to that. And that would be trying to do it for as short as time as possible. Once again, this is an advanced strategy because I don't know how many of us have time to watch something like this. Carefully, be sure we're okay, that sort of thing. You may be better off just using some of the butterfly strategies that have that better defined risk parameters and open-ended. You can really get hammered on this. You know what? If you think about it, there's still that scenario out there where it's not as common as it used to be, but there is news that comes out of takeovers, that sort of thing. I wouldn't be a takeover. A takeover of FX. In FX, there's certainly a lot of economic stuff, a lot of geopolitical stuff that happened overnight. Has happened recently. That has caused some very sharp price action following the day because of things, interest rate movement. You name it, every day we have very strange economic stuff going on. Strange decisions being made, at least my opinion anyway. Okay. These, however, are well to temper the volatility, and also for FX, it has become range bound. It gets in that little narrow channel. So they do work well within that. Okay. Currency rates sometimes, as I mentioned several times, have exactly normal moves. So they pop up. So have a solid stop loss. Stick to it when you get into this type of trade. For a short period of time. Things can turn on a dime sometimes. That's why the ratio backspread with a longer time period for it to work out, that in and of itself tempers out some of this intraday volatility that you can have in the currency trade. And that's fine. So what are the advantages for ratio? Well, it is an income trade. You get in the account. It is a good way to engage the market in the time of range-bound movement, stagnant volatility, and volume. Those do occur. Haven't remembered too many of those recently. Anyway, I don't think we've had extended periods of that. But the point of the matter is, if you need to stay engaged in the market, potentially do it when it's difficult because nothing's moving really significantly. And the disadvantages, once again, it's got a limited risk potential and it's concentrated. So we buy 1 to 2 lower strike calls, trade, we sell 2 or 3 higher strike calls, underlying and expiration remains the same. If we establish for net credit, we're better off because we want it to be an income trade. Stop loss, we want to unwind close to expiration. The maximum value usually is pure vertical. Another name, by the way, the vertical ratio vertical spread is near expiration. Okay, it's going to be achieved at the expiration is at that point. The break-evens at expiration is established for a net debit between potential break-even. The downside break-even, the lower strike plus the net debit. The upside break-even, higher strike, maximum reward. Established for the net credit, there's only one, a higher strike plus the maximum reward. Your optimal outcome at really close to the higher strike at or near expiration. When we're talking about these ratio spreads, I realize when I'm sitting here, and I'm a couple of times, that this is clearly something that we're going to need to spend time on and get comfortable with. And obtaining full copies of these slides or going online and getting some information, spending some time, really important. This is not intuitive by any means. This is study pencil work. You need to think through all these different break-even, optimal outcomes, that sort of thing. All very comfortable. Clearly recommend using do paper trading on these. See how they work out. The good and the bad. Okay. That's on it, because these are definitely not your average. There, if you will. There's the ratio call spread, and it's also called ratio vertical spread with calls.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.